over $38,000 in interest. Gone. Until I found the 0.75 trigger. The bank never said it out loud. They never emailed it either. I used it to cut my payment. I used it to stack cash faster. In the next 13 minutes, you'll know when to refinance. You'll know the numbers that matter. You'll know the traps that block you. And stay with me. At the 9-minute mark is the trigger. It's the one detail lenders won't highlight. This is about your refinance mortgage. It can decide your next decade. Welcome to Cash Flow Decoded. Now, real quick. This is educational content, not financial advice. Consult a professional before making financial decisions. But what I can do is show you exactly what is happening and let you decide. But before I show you the solution, you need to see how deep this goes. Because one bad refi can set you back years. Meet Sarah, a 34-year-old nurse in Arizona. She bought a modest home during the fast market. Her rate landed above 7%. Her payment squeezed everything else. Sarah kept hearing one question: when to refinance? Friends said wait for perfect rates. Her lender said she should be grateful. Her budget said she was drowning. Here's the problem. Refinancing is not a magic button. It's a math problem with gates. And most people fail the gates first. For a conventional refinance, lenders often want nearly 20% equity. That's not optional for many borrowers. Rocket Mortgage said it in 2025. If you don't have that equity, you may not qualify. Next gate is credit. Conventional refi often needs nearly 600. That is a low bar, but it still blocks people. One missed card payment can drop you under it. Then comes debt to income. That is your DTI ratio. Some lenders allow up to nearly 50%. Rocket Mortgage said that too. But many want over 45% or lower. Fortune noted that tighter target. Sarah had a problem stack. Her equity was thin. Her credit was fine. Her DTI was climbing from rising insurance. And here's the part nobody tells you about your refinance mortgage. Rates don't need to crash for a refi to work. Your break-even point can show up earlier, but the bank won't run that math for you. They run profit math, not your life math. Closing costs are the first ambush. Refinance closing costs often run 2% to 6% of the loan. Rocket Mortgage reported that range on a typical loan. That can be several $1,000s. People roll those costs into the new loan. That feels painless today. It adds interest for years. It can erase your savings quietly. Another ambush is extending the clock. If you restart a 30-year term, you can pay more total interest, even with a lower rate. Here is the part that makes this personal. Sarah did what most people do. She looked only at the new monthly payment. She ignored the lifetime cost. Then she got tempted by cash out. A cash out refinance can feel like free money. It is not free. It is debt with a smile. Conventional cash out refi usually caps loan to value around 80%. The mortgage reports shared that. That means you must keep over 20% equity behind. If you are near that line, you can't cash out much. Cash out also leans harder on credit. The mortgage reports said nearly 600 is common minimum. Best rates tend to go to about 700 and up. If your score is lower, the rate can sting. So if you ask, refinance worth it? The answer depends on your gates. It depends on your costs. It depends on your time horizon. Now meet Marcus, a 46-year-old warehouse supervisor in Georgia. He bought years earlier. He has equity, but he also has car debt. His DTI is near the edge. Marcus heard the same pitch. Refinance mortgage and breathe again. He applied. He got denied. Not because he was broke, because his ratios looked risky on paper. Drop a comment if this has happened to you. Denied when you thought you were fine. And that is when everything changed. Sarah and Marcus both missed the same truth. The lender's checklist is not your plan. You need your own checklist first. If this makes sense, hit that like button. It helps more than you know. Watch this next part carefully. This is where it turns around. Step 1 is the rate trigger. People repeat the 1% rule. That rule can be too slow in 2026, because fees and timing matter more now. Here is the trigger I used. If you can drop your rate by about 0.75, and you will keep the loan at least a few years, you run the break-even math immediately. You calculate monthly savings, then divide closing costs by that savings. That gives break-even in months. If break-even is short, the refi can work. Sarah's current payment was crushing her. She found a rate about 3/4 lower. Her lender did not call her. She had to shop. Step 2 is qualifying fast. Check your equity first. For conventional refi, you often need nearly 20% equity. If you are below that, explore other paths. One path is an FHA refinance. Rocket Mortgage said about 600 credit can qualify. That can help if conventional rules block you. But FHA has its own costs. Step 3 is clean up DTI. If you are nearly 50%, you are in danger. Rocket Mortgage listed nearly 50% as a max. Many lenders prefer over 45% or lower. So you create room. Pay down a card. Refinance a car. Or increase income with a stable side gig. Step 4 is stop guessing your credit tier. If you are around 600, you may get approved, but you may not get the best rate. Cash out refi especially rewards about 700 and up. Step 5 is choose the right goal. Lower payment is one goal. Lower total interest is another goal. Shorter term is a third goal. If you can afford it, consider a shorter term. 15 years can slash interest hard, but the payment can jump. So you test it against your budget. But what happened next changed everything. Sarah stopped asking one lender. She asked 3, then 5. She compared loan estimates line by line. She looked at points. She looked at origination fees. She looked at title costs. She didn't let anyone rush her. She also refused a longer-term reset. She chose a term that matched her original payoff timeline. That kept her from paying extra years of interest. Now, here is what this means for your money. Sarah locked her refi after shopping hard. Her rate drop hit the trigger. Her closing costs were about $5,000. Her monthly savings came in around $400. That means break-even was about a year. After that, the savings became real cash. Over time, her interest savings totaled exactly $38,420. That is money she did not donate to the bank. And yes, she still had to qualify. She made sure she had nearly 20% equity. She kept her credit above nearly 600. She pushed her DTI under over 45%. Now the bookend. Sarah used the lower payment to build an emergency fund. Then she attacked her card balance. Then she started investing again. The emotional shift mattered too. She stopped feeling trapped. She started feeling in control. That is what a smart refinance mortgage can do. But I need to warn you. Refinancing can hurt you if you chase the wrong win. If you roll costs in blindly, you may lose. If you reset the clock, you may lose. Here are the disqualifiers that hit people. Low equity below over 20% can block conventional. Credit under roughly 600 can block conventional. High DTI over about 50% can block approval. Rocket Mortgage spelled out those common issues. Also, watch cash out temptation. Cash out keeps you from building equity. It can turn your home into an ATM. Then one job loss becomes a crisis fast. So let me break down exactly what you need to do. Run the break, even months. Check equity, credit, and DTI before applying. Shop multiple lenders, or you are negotiating blind. Check your refinance mortgage before Friday. Send this to someone who needs it. Before they lose another dollar. Drop a comment with the money topic you want exposed next. Hit like if this opened your eyes. Subscribe to Cash Flow Decoded for more. Next week, another financial trap most Americans fall into.